Have you ever wondered why the money in your pocket feels different today? In the modern world, money births money. You lend $1, you want two back. It's a cycle of debt that never ends. But 400 years ago, in the bustling markets of Medina, the greatest men in history built empires of wealth without charging a single penny of interest. They didn't rent money, they shared risk. Today, we are diving deep. From the billionaire Sahaba like Abdurrahman bin Auf, may Allah be pleased with him, to the modern boardrooms of Mufti Taqi Usmani. Is Islamic banking real, or is it just a label? And how did the Prophet Muhammad, peace be upon him, handle debt? Let's unlock the secrets of the divine economy. First, let's clear the basics. In the traditional Western system, money is treated like a commodity. If I give you money, I charge you rent for using it. That rent is interest, riba. It doesn't matter if your business fails or succeeds. I get my guaranteed cut. The rich get richer and the poor get crushed. Islam flips this upside down. In Islam, money is just a medium of exchange, not a product itself. You cannot make money from money. You must make money from activity, trade, labor, or investment. In traditional banking, I lend you $10,000. You pay me back $11,000. Riba, haram. In Islamic banking, I buy a car for $10,000 and sell it to you for $11,000 in installments. Murabaha, halal. Why? Because in the second scenario, I took the risk of buying the car. If the car burned down before I sold it to you, I lose the money, not you. Risk justifies the profit. You might think, is this practical? Let's travel back to the golden era. The Sahaba weren't just praying in the mosque, they were titans of trade. When Abdurrahman bin Auf, may Allah be pleased with him, migrated to Medina, he was penniless. The Ansar offered him half their wealth. Did he take it? No. He famously said, "Show me the way to the market." He started selling dried yogurt and butter. His strategy? 1. High turnover. He didn't wait for massive profits per item. He sold quickly for small margins. 2. Cash deals. He avoided complex debt webs. 3. Transparency. If a camel had a defect, he announced it first. He was so blessed that he said, "If I were to lift a stone, I would find gold underneath it." He didn't need interest. He needed barakah, blessing, through honest trade. But did they ever take loans? Yes, but never with riba. There is a Sahih Hadith, Bukhari, that tells us the Prophet Muhammad, peace be upon him, passed away while his iron armor was mortgaged, ran, to a Jewish merchant in Medina. Why? Prophet Muhammad, peace be upon him, had bought barley for his family on credit. He didn't pay interest on the delay. Instead, he gave a physical asset, the armor, as security, collateral. This proves that secured debt is 100% Islamic. You can take a loan and you can give security, but you cannot pay extra money for the delay. Fast forward to the 21st century. The world is drowning in interest. Enter Mufti Taqi Usmani. For decades, Muslims thought banking was totally haram. Mufti Taqi Usmani, along with other scholars, did something revolutionary. He helped standardize the rules, AAOIFE standards. He showed the world how to take modern tools, like letters of credit, mortgages, and insurance, and strip away the riba, replacing them with asset-backed contracts like ijara, leasing, and murabaha, cost plus. Today, thanks to these efforts, major global banks, even non-Muslim ones, are opening Islamic windows because they realize this system is more stable. It connects finance to the real economy, assets, not the bubble economy, derivatives. Now, I know what you're thinking, and this is the most common comment I get. Brother, Islamic banks are the same. They just changed the name from interest to profit. Let's be honest. At the back end, the math often looks the same. If a conventional bank charges 5%, an Islamic bank might calculate their profit margin to match that 5% to stay competitive. But the difference is in the contract, aqad, and the risk. Scenario: you are late on a payment. Conventional bank charges you compounding interest. The debt grows forever. Islamic bank may charge a penalty fee, but they cannot keep it. They must donate it to charity fund. They cannot profit from your misery. Scenario: the house burns down before the title transfers. Conventional bank, you still owe the loan. Islamic bank, since they technically own the house during the transaction, they bear the risk of the asset. Are some banks cutting corners? Yes. Some scholars, including Mufti Taqi Usmani himself, have critiqued the overuse of tawarruk, a controversial method to get cash. He pushes for the ideal, musharaka, joint partnership, where the bank and you actually share the profit and loss. We aren't there yet, but we are on the journey. Islam doesn't forbid business, it forbids exploitation. The Prophet Muhammad, peace be upon him, and his companions showed us that wealth is a tool for good, provided it's earned through risk, effort, and fairness, not by squeezing the needy. The next time you look at your bank statement, ask yourself, is my money growing through partnership or parasitism? The choice is yours. If you enjoyed this deep dive, hit that like button and tell me in the comments, do you use Islamic banking or do you stick to cash? Let's discuss. Peace be upon you.